Welcome to week 7, our finance, stocks, and bonds week. Okay, if you look here, I have gotten a couple really good videos. They're rather long, but I thought they were really interesting. How the rich get richer, money in the world economy, and the 1929 stock market crash. They're both documentaries, so they're not for Hollywood type of entertainment, but I thought they were very good movies, videos. Okay. We also have the Dow Jones Industrial Average. This is the list of the 30 companies that make up the Dow Jones Industrial Average. Here's an article about the website about the bond market. And here's bonds are sold to pay for the debt. And so if you click on this one here, that gives you the US debt clock. As you can see, it's still running. Now, what I thought was pertinent to this, as far as um, bonds go, is right here is the national debt. National public debt outstanding represents the face amount or principal amount of marketable and non-marketable securities currently outstanding. By securities, they're talking about bonds, treasury notes and bills, bonds, treasury or U.S. bonds. Of this 25,267,953,000,000, no, 154 million. Um, Over 7 trillion of it is owned by foreign countries. Okay? And then the others are owned by companies and businesses, and the Federal Reserve has a lot. When we say we owe Social Security trillions of dollars, this is what they're talking about. The U.S. government borrowed trillions of dollars from the Social Security surpluses that we had a surplus ever since Social Security was created back in the 30s, and we don't have a surplus anymore. We actually have a deficit. If you look at it, it says that the Social Security made more money last year than what they paid out. Excuse me, and that's true, but that's only because of the interest that the U.S. government paid because of all the money they borrowed from Social Security. If you remove the interest that they received from the bonds that they owned, by they I mean Social Security, Department of Social Security, we actually had less money put in through our paychecks than the money that was paid out for people that are retired. And SSI is on there as well, but it's mainly the people that are retired. So, in other words, we are now paying more than receiving in Social Security. And if you look here, Social Security, Medicare, Medicaid, those two combined, almost $1.3 trillion, and that's for this year. Social Security is getting close to $1.1 trillion is what we paid this year. And the defense is 690, close to $700 billion this year. And then the interest that we pay on the debt. So one, two, three, the fourth largest expense that we have in the federal budget is the interest that we pay on our bonds. And that's getting close to $400 billion this year. Okay? And that's based on this number here. Now, this here is how much money we spent for this year officially, but in reality, we spent half a trillion more, excuse me. It's officially it was almost 602, or excuse me, 6.2 trillion. Unofficially, how much money we actually paid out was $6,650,000,000. And and then this is our deficit because this is the amount of money that we took in. 3.4 trillion is how much money we took in from income tax revenue, payroll tax revenue, tariffs, corporate tax revenue. Notice that they're all going down. Notice how they're decreasing, and that's because of the orders to stay in place and closing all the businesses. So the money is actually decreasing that they were supposed to be collecting. But our spending, of course, has not stopped. It's increasing dramatically. So the difference between these two, excuse me, the difference between this one and this one is the deficit. So this is what we spent, excuse me, this is what we earned, green, is how much money we earned. This is how much money we spent officially, how much we actually spent. And then these are the differences. So that's a deficit. This is all the deficits added together is our national debt. So every year we have a deficit, we add it to the national debt, and that's how much we owe total. Okay? So I thought that was kind of interesting. So let's go back and look at the chapter. Week 7 and week 8. I'm sorry. Picked the wrong one. No. Yeah, I put that in the wrong one. I was in the right one. That's the wrong one. I'll have to put that in the correct one. I have to move that over. Okay, so here we are in stocks and bonds. There's a lot of different um, PowerPoints and notes in here. So PPT is PowerPoints, PDF are notes. I put all these in here for your benefit as far as learning as much as you wanted to learn about stocks and bonds. I don't know if that's your interest or not. But I wanted to allow you the opportunity to learn more than what I was able to provide in just the 2 weeks that we have this um, topic. So right now, I'm just going to talk about stocks and the stock lecture. Okay. So stock valuation. They're between debt and equity. Debt includes all the borrowing incurred by a firm. So when we're looking at the national debt, those are bonds. Okay, everybody that has a bond lent money to the U.S. government. They don't own part of the U.S. government. That would be equity. Equity consists of funds provided by the firm's owners, investors, stockholders, that are repaid subject to the firm's performance, and they're usually repaid in forms of dividends. But they don't have to. They always own the same amount of shares unless they sell them. Bond the debt, which is by bonds, you don't own any part of the company. The company just owes you the money. Okay, so you can finance a business either through debt, you just borrow the money, but you still own the company. By equity, where you sell part of the company to other people, or a combination of the two. Differences between debt and equities, but I just went over. Um, Maturity. Unlike debt, equity capital is a permanent form of financing. Equity has no maturity date and has to be repaid by the firm because you own part of the company. When you go buy a stock, that's equity, and you own part of the company. Let's look at this thing. So types of capital, debt versus equity. Voice in management, debt has no voice in management. Equity does have a voice in management because they own part of the company. Claims on income and assets, senior to equity, subordinate to debt. Okay, and maturity stated none, and then tax treatment, interest deductions and no deductions. Okay, so equity, there's no tax treatment because you're selling part of the company to somebody. And tax treatment for debt, well, that's income for the person that's receiving the interest, and it's an expense for the person paying the interest. By person, I mean business doing it. Okay. Common and preferred stock. Common stockholders, who are sometimes referred to as residual owners or residual claimants, are the true owners of the firm. They receive what is left if the firm gets sold, or if dividends are declared, they receive the dividend. Um, After all the claims on the firm's income and assets have been satisfied. In other words, the owners get paid last, is what this is saying. They are assured of only one thing, that they cannot lose any more than they have invested in the firm. So if the company gets sued, they're not liable for that lawsuit. They just invested so much money to buy so many shares of stock, and the most they can lose is that amount of money they invested in the stock. And then That's it. So it's a limited liability for them. Okay. The common stock of a firm can be privately owned by a private investor. You or me could buy the stock on the stock market. Just go out on Scottrade or uh, Charles Schwab or one of those and buy the stock. Shares of privately owned firms. Any company can go out and buy stock in another company. And large corporations are publicly owned, and their shares are generally actively traded in the broker or dealer markets. Preferred stock gives to its holders certain privileges that make them senior to common stockholders. Preferred stockholders are promised a fixed periodic dividend, which is stated either as a percentage or as dollar amount. Par value preferred stock is preferred stock with stated face value that is used with specified dividend percentage to determine the annual dollar dividend. Okay. No par preferred stock is preferred stock with no stated value, but with the stated annual dollar dividend. So par stock is a lot like a bond because it has a stated value and it's guaranteed the dividend. Non-par, the stock goes up and down. The price of it goes up and down, but they still are guaranteed that dividend. They also have no voting rights. Considered quasi-debt because much of the interest debt, unlike debt, has no maturity date. So why would you do preferred stock instead of a bond if you were a business? You don't have to pay the stock back, the money back on that preferred stock, where you do have a maturity date on the bond that you have to pay it back. They have a fixed claim on the firm's income and not only given voting rights. That's the other disadvantage, other than they don't have voting rights. Restrictive covenants, including provisions about passing dividends, sale of senior securities. Cumulative preferred stock is preferred stock which all past unpaid dividends in arrears and along with current dividends must be paid before dividends can be paid to common stockholders. So like right now during this pandemic, if the company isn't making enough to pay the bond holders and their interest that's due and the preferred stockholders interest that is due, dividends, I'm sorry, not interest, dividends that are due, if they don't have enough money to pay both of those in that order, then the common stockholder doesn't get a dividend. If they only have enough to pay the bonds, the interest on the bonds, and the dividends on the common stock, or excuse me, on the preferred stock, the common stockholder doesn't get anything then either. So the common stockholder is always the last one to be paid. Callable feature is a feature of callable preferred stocks that allow the issuer to retire the shares within a certain period of time and a specified price. So if you wanted to only have preferred stock out there for a certain amount of time and then you wanted to retire it so that you don't have to keep paying those dividends, you can do that, but you have to do that when you issue them. You can't change them after that. It needs to be done when they're issued. And conversion features a feature of convertible preferred stock that allows holders to exchange shares into common stock. So if it has a conversion feature, again, when they issue them, they have to have this. So when they actually issue the preferred stock, they can either have a callable feature or they can have a conversion feature so they can convert them to common shares if the owner of those shares wants the conversion. Now, why would you want the conversion? Well, because common shares tend to increase in price, where preferred stock doesn't tend to increase in price as much because it doesn't have voting rights, which is the other thing. Okay, and then the last one, going public, a public offering, which shares are sold. It's called an IPO, initial public offering, and that's when a private company goes public, and instead of having a private ownership, it turns out to be a public ownership, and now whoever buys the stock owns the company. That's it. Hope you have a good week.